Right, let's talk about the economy, specifically the terrifying recurring nightmare that is a full-blown economic meltdown. You know, the kind of event that makes your grandparents say things like, "Back in my day, we used a turnip for a baseball and we're grateful for it." This isn't just about numbers on a screen or charts that look like a heart attack EKG. It's about real people losing their jobs, their homes, and their hope. And the biggest, scariest ghost in this haunted house of financial horror is, of course, the Great Depression. It's the benchmark for economic misery, the Godzilla of financial calamities. It was a decade-long financial winter that left scars on an entire generation. The Great Depression wasn't just a bad quarter, it was the economic equivalent of a meteor strike. It was a period in the 1930s when the global economy decided to just stop. Banks failed in droves. Unemployment skyrocketed to a quarter of the workforce. It was a time of immense suffering that fundamentally reshaped how we view the role of government and the stability of capitalism. It's the story we tell our financial systems at night to scare them into behaving, and frankly, given recent events, it seems like they might need a refresher course. So, the Great Depression. What actually happened? Imagine the Roaring Twenties. Jazz illegal booze, a stock market that only went up. People were buying stocks on margin, borrowing money to gamble on the market. It was like a national casino where everyone was sure they had a winning system. Then, on October 29, 1929, a day charmingly nicknamed Black Tuesday, the music stopped, the stock market crashed spectacularly, wiping out fortunes overnight. And this wasn't just a problem for a few rich guys in top hats, it was the first domino in a chain reaction of pure economic chaos. The crash itself didn't cause the depression, but it was the spark. The real problem was a perfect storm of underlying weaknesses. For one, the banking system was a house of cards. When people panicked and rushed to withdraw their savings, a bank run, the banks which had gambled away depositors' money simply collapsed. Thousands of them failed, taking people's life savings with them. There was no FDIC insurance back then. Fast forward a few decades. After the post-war boom, America got complacent. We thought we had this economy figured out. Then the 1970s arrived. They brought a new economic monster, stagflation, high inflation, high unemployment. They shouldn't coexist. A key culprit, an oil shock. In 1973, OPEC imposed an embargo. Suddenly the price of oil quadrupled. Oil powers our cars, heats our homes, makes plastics and fertilizer. Prices for everything went up. Businesses started laying people off. It was a supply-side punch to the gut. It took a new Fed chairman, Paul Volcker, to break its back. He jacked up interest rates to about 20%. The Volcker shock plunged the economy into a deep short recession. It was messy and painful, but it ultimately killed the disease of inflation. The 70s taught us external shocks can derail an economy, and that controlling inflation, even at great short-term cost, matters. All right, let's jump to a crisis many of us remember all too well, the 2008 financial crisis. This one wasn't caused by oil shortages or stock market speculation in the traditional sense. No, this was a masterpiece of modern financial engineering gone horribly, predictably wrong. It all started with the United States housing market. For years it seemed like house prices could only go up. Lenders, drunk on this assumption, started handing out mortgages to literally anyone with a pulse. These were called subprime mortgages, which is a polite term for loans given to people who probably can't pay them back. Instead of holding these risky mortgages, banks bundled thousands into complex financial products. Mortgage-backed securities, collateralized debt obligations. Think of it like a financial lasagna, layers of good mortgages, layers of terrible, toxic mortgages. They then got credit rating agencies to slap a safe AAA rating on this toxic lasagna. Then they sold these ticking time bombs to investors all over the world, pension funds, other banks, who thought they were buying something as safe as government bonds. The whole precarious tower was built on the belief that house prices would never fall. But in 2006 and 2007 they did. Homeowners started defaulting in droves. As they defaulted, that financial lasagna began to rot from the inside out. Credit markets froze. The climax came in September 2008 when Lehman Brothers was allowed to fail. Panic ensued. Governments had to step in with massive bailouts, privatizing profits and socializing losses. And that brings us to our most recent economic trauma, the one that's still fresh in our minds, the COVID-19 recession of 2020. This crisis was utterly unique. It wasn't caused by financial shenanigans, it wasn't an oil embargo, it was caused by a virus. Governments deliberately shut down huge chunks of their economies to slow the spread of disease. Restaurants, bars, gyms, movie theaters, countless other businesses were ordered to close. People were told to stay home. The world pressed the pause button on normal life. The economic consequences were immediate and severe. Unlike other recessions that develop slowly, this one happened virtually overnight. In the spring of 2020, unemployment in the U.S. shot up to nearly 15% in weeks. Policymakers responded with unprecedented speed. The Fed slashed interest rates to zero and launched massive asset purchasing programs. Congress passed trillions in relief, enhanced unemployment benefits, forgivable PPP loans, direct stimulus checks. The goal? Build a bridge to get people and businesses to the other side. It was a fire hose of money. It prevented a depression but had consequences. While it prevented a depression, it also helped fuel the inflation problems we face today. When the world reopened, consumers spent, supply chains couldn't keep up, and too much money chased too few goods. So here we are in late 2025 sipping on a rather unsettling economic cocktail. The main ingredient? Inflation. After the pandemic, prices shot up at the fastest rate in 40 years. Gas, groceries, it ate away savings and wages. The Fed did what it always does, aggressively hike interest rates to cool spending. But that medicine has side effects. One big side effect, a wave of layoffs, especially in tech. Result, a weird two-track economy. Some sectors strong, others facing brutal reckoning. Global weirdness adds to the mix. War in Ukraine, US-China tensions, climate shocks. All this breeds uncertainty. Markets hate uncertainty. The Fed aims for a soft landing, but turbulent skies make a crash a real risk. Comparing today to yesterday's disasters, is this 1929 all over again? The short answer is, probably not. Let's compare. The Great Depression was characterized by massive deflation, falling prices and bank collapses. Today our main problem is inflation, the opposite, and our banking system is far more resilient. FDIC insurance and post-2008 regulations prevent the bank run scenarios of the 1930s. So, how about the 70s? There are similarities, stubborn inflation and energy shocks, but key differences exist. Today the US is a major oil producer and the economy is less energy intensive than in the 70s. What about 2008? That was a financial crisis born of toxic assets. Today banks are better capitalized and housing is tight, not bubbly in the same way. Today is a bizarre hybrid. 70s style inflation, tech and crypto asset bubbles, and the supply chain chaos of COVID, all layered together. The good news, institutional safeguards and policy tools exist that didn't in the 1930s. The bad news, the combination of challenges is unique and lacks a clear playbook. So what do the people who are paid to have opinions about this stuff think? Are we heading for the economic abyss? The consensus among most mainstream economists is that a repeat of the Great Depression is extremely unlikely. They point to safeguards, FDIC, a more active Fed, unemployment benefits, social safety nets that act as automatic stabilizers. A recession is a real possibility and may even be necessary to curb inflation, but it will likely be milder and much shorter than the Depression. A pessimistic camp warns about global debt, governments, corporations, and households leveraged to the hilt since 2008 and COVID. Central banks raising rates to fight inflation makes servicing that debt more expensive and could trigger defaults. It's a rock and a hard place scenario. Let inflation run or raise rates and risk blowing up a debt-laden economy. Deglobalization and fragile supply chains could be messy and inflationary. Experts generally say we're not on the verge of another Great Depression, but we are in a period of heightened vulnerability where policy mistakes or new shocks could have outsized consequences. So, after our whirlwind tour through a century of economic faceplants, what's the takeaway? Are we doomed to repeat the mistakes of the past? Not necessarily, but it requires us to actually pay attention. The first and most critical lesson is that we need robust guardrails. FDIC, SEC, Social Security. These pragmatic measures saved capitalism from its worst instincts. Maintaining and strengthening regulatory bodies isn't red tape, it's insurance. Second, policymakers need humility. The 70s and 2008 taught us orthodoxies and models can be wrong. Third, build long-term resilience. Invest in infrastructure, diversify sources for critical goods, and not put all eggs in one geopolitical basket. Address soaring inequality. A strong middle class with purchasing power is the ultimate shock absorber. Preventing the next Great Depression isn't a magic bullet. It's learning from ghosts of our past, valuing stability over short-term profits, regulation over recklessness, and cooperation over chaos. The warning signs are flashing. This isn't a time for panic, but it is a time for vigilance. Because the moment we think we've solved the business cycle is often the moment it punches us in the face.